Hey folks, hope you are doing well. I'm Karan Bandal from Econosite, and in this video, let's talk about how China is looking to export its way out of the real estate crisis as the rest of the world resists goods dumping by China. We'll start with a brief review of China's manufacturing sector in a global context. China is known as the world's factory for a reason. It already produces almost a third of the world's manufactured goods, more than the US, Japan, Germany, South Korea, and Britain combined. And its manufacturing dominance may be about to get deeper. China used to be known for its exports of low-cost goods from labor-intensive industries. It appears China's export dominance is extending into high-tech goods now. Here are just three of the many examples. Before the COVID-19 pandemic, China was not a major player in car exports. But last year, China became the world's largest exporter of cars with over 5 million cars shipped out of the country. Even though their EV exports attract more eyeballs, most of these exports were traditional gasoline-powered cars. Chinese cars have captured over half of the market in Russia. In terms of value, China's car exports alone stood at over $100 billion. Add to that another $85 billion worth of auto parts exports. Second, to move its glut of cars to distant markets, China has begun building its own fleet of 170 transoceanic ships. For perspective, before the COVID-19 pandemic, world's shipyards were delivering only 4 of these vessels a year. Now imagine the scale at which China is operating. So ships themselves have emerged as a major export from China, more than doubling in Q1 of 2024 against Q1 of last year. Finally, solar panels and the relevant components like solar wafers are among the fastest growing Chinese exports as measured by quantity. Wafer exports nearly doubled in 2023, but since solar product prices nearly halved, the total value of China's solar exports edged down a bit. So China's global manufacturing dominance is not in question, but global powers may have legitimate concerns around how China continues to achieve this dominance. Western powers accuse China of artificially subsidizing its manufacturing sector, which results in global markets being flooded with low-cost Chinese goods that ultimately ends up adversely affecting the manufacturing sector of the importing countries. And when I said in the beginning that China's export dominance may be about to get deeper, that's because China is doubling down on this strategy. China's state-directed banks are shoveling money into manufacturing businesses. With these loans at low interest rates, companies can afford to build factories with lots of robots and invest in research and development. In numbers, the net increase per year in lending to manufacturing industry was $83 billion in 2019. By 2023, annual increase in industry loans had skyrocketed 8-fold. China is building factories like never before, even when the global demand may not warrant the added supply. So I believe that's why China is being investigated for unfair trade practices. US has begun an investigation into China's shipbuilding industry. European Union has opened an investigation that could result in limits on China's solar, EVs, wind turbines, and medical devices exports. US also has called for similar restrictions, including on steel and aluminum from China. But why is China pushing exports so much? Well, the construction of apartment buildings used to drive China's economic growth. But the decades-long housing bubble has burst, apartment prices continue to fall, dozens of real estate developers have run out of money, and consumer confidence remains weak. So the hope is that strong exports and a massive investment in factories will help offset the housing debacle, leading to a strong economic growth. China needs to be careful here. Experts posit that China's manufacturing overcapacity may backfire. The increase in lending to industry worked in the first 2 months of 2024, but the industrial output has already slowed in March. In addition to that, economic data revealed manufacturing capacity utilization falling to below 75% in Q1, indicating a rising overcapacity already. This is the weakest reading since at least 2015. Add to that, manufacturing capacity utilization in automobiles is in low 60s and in electrical machinery is in low 70s, making them even worse off. These sectors are considered as new product forces that are to drive China's high-tech exports like EVs, chips, solar, etc. Then in volume terms, China's exports hit a nearly 10-year high in March, but in value terms, they are still down about 20% from December 2021 levels. Bottom line, there is a lot of excess manufacturing capacity in China already, and since exports in value terms are still struggling, it indicates that Chinese firms lack pricing power both at home and abroad. Now, if the external demand doesn't firm up and China's domestic economy remains weak, will the Chinese manufacturing firms make a profit? If not, then banks that are lending to the manufacturing industry may have to start absorbing loan losses like they already have with real estate and infrastructure sectors, risking another bubble burst in a new sector for China. As things stand now, China continues to provide a boost to its exports and is finding ways around the trade barriers imposed by the West. China has signed 21 free trade pacts with 29 countries and territories in recent years, including with those in Southeast Asia. So China is still shipping goods to the West, but through these countries. Then Chinese companies like Shein send packages directly to US homes, avoiding tariffs, because the US allows its residents to import up to $800 a day worth of goods without paying tariffs. That's nearly $300,000 a year per resident. Chinese EV companies like BYD are looking to set up factories in Mexico, potentially bringing Chinese EV production in the NAFTA free trade zone, gaining a backdoor in the US market. China is indeed going all in on its exports push. In summary, China's strategy to deal with its economic troubles is to double down on its manufacturing sector. This is making the issue of overcapacity in global manufacturing worse in certain sectors. The West is trying to discourage this move through imposition of trade barriers, but China may have already found ways to dodge them. Next few years will reveal winners and losers coming out of China's renewed exports push. I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.